All right, let's dive right into Lifetime's third quarter earnings call. Management came out swinging with a message of pure confidence in execution. And believe me, the market heard them loud and clear. So let's get straight to the numbers.
And when I say the market took notice, I am not kidding. The stock just popped over 5% on more than double its usual trading volume. I mean, that's not a whisper. That's the market screaming its approval. So you gotta ask, right? What was all the excitement about?
Okay, here's how we're going to break this all down today. First up, we'll hit the headline numbers. Then, we're going to peek inside management's playbook and figure out how they pulled this off. After that, we'll see what Wall Street had to say about it. And finally, we'll wrap it all up with our own take, what we call the next call.
All right, first up, the headline numbers. And let me tell you, this was a decisive beat.
So check this out. It's the quality of the beats that really tells the story here. Adjusted earnings per share, 41 cents. The street was looking for 34. That's a 21% beat, a huge surprise on the bottom line. And revenue, they beat that by over 12 million bucks. There's just no other way to put it. This is pure, unambiguous strength.
And this is where it gets really interesting. You can see the operational leverage kicking in. Yeah, revenue growth was solid, up almost 13% year over year. But look at adjusted EBITDA. That's up a massive 22%. So what does that mean? It means their profits are growing way faster than their sales. That's the margin expansion story that investors absolutely live for.
So, the big question is, how did they do it? Well, this wasn't just luck. Let's get into management's playbook.
This quote from the CEO, Barack Macriers, really says it all. He's talking about a new baseline for growth. Think 12 to 14 new clubs every single year. This isn't some one-off bump. He's basically telling the market, get used to this faster pace of growth. And hey, they've got the financial muscle to make it happen.
So their strategy boils down to three key things. One, floor it on the new club growth, just like the CEO said. Two, they're being super smart about how they pay for it. They're using these sale-leaseback deals to free up cash, which keeps their balance sheet looking clean. And three, and this is a big one, they're finding new ways to make money beyond just memberships.
And this is where they're getting really creative. They're building what you might call revenue flywheels that go way beyond the typical gym stuff. They're adding these digital and product layers. You've got LAIC, which is their new AI wellness companion. Pretty cool, right? It's all about keeping you engaged and selling you other services. Then there's LTH Dream, a sleep supplement. They're taking their trusted brand and jumping into the huge wellness market. See? They're not just building a gym anymore. They're building an entire ecosystem.
And if you want proof that management is feeling good, look no further. They didn't just beat the quarter, they raised their guidance for the entire year. We're talking higher targets for revenue, for net income, for adjusted EBITDA, everything. They're basically screaming from the rooftops that this momentum isn't slowing down.
Okay, so management's confident. The numbers are fantastic. What does Wall Street think? Well, it's no surprise. They're pretty much all on board.
I mean, the validation is just rolling in. S&P gave them a credit rating upgrade. You've got big names like Morgan Stanley and UBS getting positive on this stock. But the number that really jumps out, the average analyst price target is sitting around 39 bucks. That implies something like 50% upside from where the stock is now. 50%. The street is clearly saying there's a lot more gas in this tank.
Okay, so let's recap. We've got a killer quarter, a confident management team with a solid plan, and a very happy Wall Street. So that brings us to our take, what's next, and how do you play it?
And this is the question every single investor has to ask themselves after a run like this. What's the next move? Do you jump on the bandwagon, or is all the good news already baked into the price?
Well, here's our call. We're rating this an outperform. Why? Because we think this story, the great execution, the faster growth, these new revenue streams, isn't fully appreciated by the market yet, not even after this recent pop.
So if you agree, here's one way to think about it. The thesis is straightforward. The good times are going to keep rolling. One way to position for that, with a defined amount of risk, is to use an option strategy like a call spread. For example, you could look at buying the January 2026 $30 call and selling the $40 call against it. The whole point of a trade like this is to capture a move up towards that $39 analyst target, but you know exactly what your max risk and reward are from day one. And as we go forward, these are the key things you've got to watch. Number one, how does Q4 play out? Are they hitting their numbers? 2, keep an eye on the new club openings for 2026. Are they on schedule? 3, we need to see some real data on how well their new AI tool and supplements are selling. And finally, all eyes are on that brand new flagship club in New York City. That's going to be a huge signal for the brand. All right, and just to wrap things up, a quick but really important reminder. Everything we've talked about today, the analysis, the trade ideas, it's all for informational purposes. This is absolutely not financial advice. You've always got to do your own homework before making any investment decisions. Thanks for watching.